You know, when I think back to 2020, credit was pretty straightforward: scores, reports, and a few big banks deciding who gets approved. But now, in 2026, credit is a whole different ballgame. It's not just about your history anymore. It's about AI, blockchain, and even your spending habits on a smart fridge. Let me walk you through the future of credit, step by step, and how you can stay ahead. First off, AI is everywhere. Credit scoring used to rely on your past behavior, like your payment history, credit utilization, and how long you've had a credit card. But in 2026, AI is rewriting the rules. Companies like Credit Shield are using machine learning to analyze not just your financial data, but also your online behavior. For example, if you've been consistently shopping for car loans on a specific website, AI can predict your likelihood of taking a loan. This isn't just about numbers, it's about patterns. A fintech startup in Singapore, LoanBuddy, recently launched a credit scoring model that uses AI to assess borrowers based on their social media activity, job stability, and even their spending on groceries. Their model reduced default rates by 18% compared to traditional methods. But here's the catch: AI isn't perfect. It can sometimes penalize people who have unconventional spending habits, like paying cash for groceries. So, if you're trying to build credit, be mindful of how your digital footprint looks to these systems. Next up, blockchain is shaking things up. You've probably heard of blockchain as the tech behind Bitcoin, but in 2026, it's becoming a game changer for credit. Traditional credit systems rely on centralized databases, which are vulnerable to fraud and data breaches. Blockchain, on the other hand, creates a decentralized ledger that's transparent and tamper-proof. For example, BitPesa, a Kenyan fintech company, uses blockchain to streamline cross-border credit transactions. By replacing traditional banks with a blockchain-based system, they've cut transaction times from days to minutes. The result? More people in emerging markets can access credit without relying on big banks. But blockchain isn't just for international transactions. In the US, a startup called CreditChain is using blockchain to create a universal credit score that's accessible to anyone with a smartphone. This means even people without a traditional credit history can build a score by proving their financial responsibility through mobile payments or utility bills. It's a big deal because it's opening the door for millions of people who've been excluded from the credit system. Then there's alternative credit data. You know how your credit score used to depend on things like your payment history and debt-to-income ratio? Well, in 2026, lenders are looking beyond that. Companies like Affirm and Klarna are using data like your rent payments, utility bills, and even your streaming habits to assess creditworthiness. For instance, if you pay your rent on time every month, that's now considered a positive signal. A case study from 2025 showed that a fintech company called PayLater used alternative data to approve 30% more loans than traditional banks, with a 15% lower default rate. The key takeaway here is that your credit isn't just about what you've borrowed. It's about how you manage your money in real life. So, if you're someone who pays cash for everything, you might want to start using a credit card or a mobile wallet to build a digital footprint. Another big shift is the rise of personalized credit products. In the past, credit cards and loans were one-size-fits-all. But now, in 2026, lenders are using data to create tailored offers. For example, a credit card company called FlexCard uses AI to analyze your spending patterns and offers you a card with a higher credit limit if you've been paying off your balance consistently. This isn't just about rewards, it's about building trust. A study from 2025 found that users who received personalized credit offers had a 25% higher approval rate than those who didn't. But here's the catch: personalized credit can also lead to higher interest rates if you're seen as a high-risk borrower. So, it's important to shop around and compare offers before committing. The gig economy is also changing the game. If you're a freelance worker or rideshare driver, traditional credit systems might not work for you. In 2026, platforms like Uber and Fiverr are partnering with fintech companies to offer microloans and credit lines specifically for gig workers. For example, in 2025, Uber launched a program called Driver Credit that allows drivers to access small loans based on their ride history and earnings. This isn't just about convenience, it's about financial stability. A case study from 2025 showed that drivers who used driver credit had a 40% higher retention rate compared to those who didn't. But again, it's important to read the fine print. These loans often come with higher interest rates, so you need to make sure you can afford the payments. Then there's the impact of the global economy on credit. In 2026, inflation and interest rates are still a hot topic. The Federal Reserve has kept rates high to combat inflation, which means borrowing is more expensive. But in emerging markets, the story is different. For example, in India, credit card usage has surged by 30% since 2023, with more people using cards for everyday purchases. This is partly due to the rise of digital wallets and the government's push for financial inclusion. However, high interest rates can still be a barrier. A 2025 report found that in countries with high inflation, credit card debt has increased by 20%, leading to more people relying on payday loans. So, if you're in an emerging market, it's crucial to manage your debt carefully and avoid falling into a cycle of high-interest borrowing. Regulatory changes are also shaping the future of credit. In 2026, governments are cracking down on predatory lending practices. For example, the EU introduced the Credit Transparency Act in 2025, which requires lenders to disclose all fees and interest rates upfront. This means you can't be surprised by hidden charges anymore. In the US, the Fair Credit Act of 2025 mandates that lenders provide more detailed credit reports, giving consumers greater control over their financial data. These regulations are a win for consumers, but they also mean that lenders are becoming more cautious. As a result, credit approval might be harder to get, but the process is more transparent. Another trend is the integration of IoT, Internet of Things, in credit scoring. Smart devices are now being used to monitor spending habits. For instance, a smart fridge can track your grocery purchases, and a smart thermostat can show how much you spend on utilities. Companies like CreditIQ are using this data to create more accurate credit profiles. In 2025, CreditIQ partnered with a major retailer to offer a credit line based on a customer's monthly grocery spending. The result? A 20% increase in credit approvals for people with low credit scores. But this also raises privacy concerns. If your fridge is tracking your habits, who owns that data? In 2026, there are new laws in place to protect consumer privacy, but it's still something to be aware of. Environmental impact is another factor in credit. Green credit scoring is becoming a reality. Lenders are now considering your carbon footprint when assessing creditworthiness. For example, a bank in Norway, Green Loan, offers lower interest rates to borrowers who have a low carbon footprint. This is part of a broader trend where financial institutions are aligning with sustainability goals. A 2025 study found that companies with green credit scores had a 10% higher approval rate compared to traditional lenders. But it's not just about the environment. Some lenders are also offering green loans for things like solar panels or electric vehicles. If you're looking to build credit, consider how your financial habits align with sustainability goals. Finally, the future of credit in the metaverse is something to keep an eye on. As virtual reality becomes more mainstream, credit is starting to extend into the digital world. In 2026, platforms like Decentraland and The Sandbox are introducing virtual credit systems that allow users to borrow in-game assets. For example, a user in Decentraland can take out a virtual loan to buy a piece of land, which can then be sold for real money. While this is still in its early stages, it's a sign of how credit is evolving beyond the physical world. So where do you start? First, check your credit score using a free service like Credit Shield or CreditIQ. These platforms use AI to give you a more accurate score than traditional credit bureaus. Second, start building alternative credit data by using a credit card or mobile wallet consistently. Third, if you're in a gig economy, look for lenders that offer microloans tailored to your income. Fourth, stay informed about regulatory changes and how they affect your credit options. Lastly, be mindful of your spending habits, especially if you're using IoT devices that track your financial behavior. The future of credit is exciting, but it's also complex. With AI, blockchain, and alternative data reshaping the landscape, it's more important than ever to stay proactive. By understanding these trends and taking the right steps, you can build a strong credit profile that works for you in 2026 and beyond. So, go ahead, start checking your credit, exploring new options, and making smart financial decisions. Your future self will thank you.